Couple of things, some basic points to make before I begin. First of all, I know you're all going to be terribly, terribly disappointed by this, but I don't have a presentation. There's no slides, there's no charts, there's no tables. I know all of you are looking forward to slide after slide of numbers and lines, but I'm an economist. I'm just not very good with numbers. What can I tell you? So I'll give you a few, but not a whole lot. The other thing is that these days I have a requirement. How many of you have a Twitter account? Nobody? Good. Because if you do, turn it off. I can't change my speech in the middle because the president comes up with something else, okay? So there's a requirement, no twittering, or tweeting, excuse me. So much for that. I have a Twitter account for my business, and the last time I did it, actually I spent more time doing things in China with the Chinese equivalent of the Twitter because somebody liked what I was doing and started translating it. Actually, I wrote a book a few years ago that was translated into Chinese. Does anybody speak Chinese? Good. Could you get my book called Big Picture Economics and tell me what I wrote? I have no idea. All I know is I wrote a book. It was published in the United States called Big Picture Economics, and we sold it to the publisher in China, and it took them 2 years to get it out. And I have no idea how they changed it. So if you could do that for me, I'd really be appreciative. And the last thing and a key point about all of this is, did everybody enjoy the ice cream break? It was good, right? I was disappointed by it. Why? Because I was hoping it would be the scooped ice cream, And the reason I was hoping it would be the scooped ice cream is that I eat the marshmallows. Yeah, I was here for that. All right. The title of this talk, I didn't title it, is Wondering What the Fed Will Do. That's a good question. I've been wondering about what the Fed would do for a while now. I wasn't quite certain. So if anybody knows, tell me, and then we both know, okay? And since I promised to leave time for questions and non-answers, I'm done. Thank you. Any questions? None? I've also been warned not to get too close to the... Before this is over, you're going to yell, jump. I know that. All right. It's really what I want to talk about today is to try and give you some ideas about what the Fed may do next, which is another point. If anybody knows, tell me, and we both know. And to do that, really, what I really need to do is get into a discussion about where the U.S. economy is going. And that's what's going to drive the Fed, unless the president drives the Fed crazy beforehand. But we're going to talk about the U.S. economy because it not only will determine where rates go, but it also has a very, very large impact on the New Jersey economy. And we'll finish off with a discussion of where the New Jersey economy is going, where it is right now, and what are really the opportunities and risks. Because clearly, the stronger the state's economy is, the more growth we have in the state, more businesses we have, the higher housing prices may actually go, or they may actually start going up once again. So you can get some more revenue out of real estate taxes. Not like you don't get enough as it is. I not just live in Pennsylvania, but I have a house in Margate. Anybody want a house in Margate? The taxes are ridiculous. You do? Okay, see me afterwards, okay? But you'll talk about where what the national outlook means as far as its implications for the state and local economies, and then we'll leave plenty of time for questions so that hopefully, if you've got some specific questions, tell me. You can yell it out, and I'll repeat them. If I can't hear you, I'll answer it anyway, whatever I want to answer, okay? All right. To get into the issue of where the Fed, is going and what they're thinking, I use the term what the Fed is thinking in a kind of general way. I'm not really sure, and I'll explain that also. You got to look at where the economy is and how strong or how weak it is. And that's really one of the big issues that we're facing right now. How many of you think the national economy's in really good shape? Anybody else? We got two now. Do I see three? Okay. We got three. Okay, that's real good. How many think that it's mediocre to poor? Most of you. And the rest of you have no idea, right? Good. That's the case. The problem we have right now in this economy is as much one of perception as it is reality. I mean, we've been told by politicians for a while, we can grow by 3-4%, which is pretty strong growth, for as far as the eye can see. Okay, they've got blinders on, but it's as far as the eye can see. The reality is that the economy can only grow so fast, and this is an important thing to understand. We're growing right now at closer to 2%. We had been growing at 3%. We're growing, in perspective, there doesn't seem to be a whole lot of difference between 2 and 3, except when you go from 2 to 3, you increase your growth rate by 50%. At least, let me get my calculator out. And remember, I said I'm not good in math. That's the situation. It is a significantly different feeling as far as the economy is concerned. You have stronger job growth, earnings are better, income growth is a lot stronger at 3% than 2%. But my point is that 2% is actually what economists call good growth, or what we actually call trend growth. What do I mean by that? What is sustainable growth? What if you grew at a certain pace, year after year after year? You could just continue growing at that rate. It's not 3%. How you get to that number is really, we put it in a black box, we massage all the numbers, and then we add two things together. This is high, math. It's called, an economy can grow in the same way any business can grow, in one of two ways. If you're going to grow a business, you can either expand your output by hiring more people, what I call the brute force way, or you can expand your output by having the people who work for you be more efficient or increase your productivity. And that's it. If you've got a third way, tell me, because there's about 10 million economists who only know two, right? So how fast can we grow depends upon how fast you can grow basically the workforce and how much productivity can you push out of your workforce. And that's it. So you just have to come up with some estimates for that. And this is fairly straightforward. Start with the issue of how fast you grow the labor force. This is simple. The next baby born in this country will not be 18 years old, so they will not enter the workforce the day after they're born, which means that essentially the demographers out there take a look at the distribution of the population, they age it, and the Bureau of Labor Statistics has about, 197 demographers working on this on a daily basis. I don't know why they have so many, but they do, okay? Trying to figure out what the births and deaths and entering into and exiting from the labor force you have. And after churning out all of these models, they take a look and they flip a coin and come up with a number. But the basic estimates, knowing the distribution of the population and considering the fact that we baby boomers, I'm a baby boomer, don't intend to work forever. We may have to, but right now we don't intend to work forever. We are starting to retire, maybe not as rapidly as we would have liked. I'm a baby boomer. I thought I would have been retired years ago. Now I know I'm going to be, after I took a look at my 401k, I determined I actually can retire when I'm 92. But, we're starting to retire. We know how many, kids there are, who are younger than 18 or younger than 16. You push it through the models, we have labor force growth, and that comes out to somewhere between 0.6% and maybe 0.75%. Because, if the boomers don't retire and the millennials, which have a pretty, surprisingly low labor force participation rate, move in a little bit more, we might get up to 0.75%, but somewhere from 0.6 to 0.75%. So that's one number on one side. The second number is productivity, and that's how fast can you grow output by really making people work more efficiently, whether it's more machinery, whether it's having them operate with robots. Just take a look at what goes on in Amazon warehouses. I don't think you really want to take a look at what goes on there, but if you do, it's very fascinating. How do you drive that? Well, we've had periods of time where it was just a couple of years ago negative and growing or less than 1%. Now we're above 2%. And economists have worked on this for years. And we basically figure the number is somewhere around maybe 1.25 to 1.75%. You don't have exact numbers. This is kind of a rough guess or so what you have. So if you take a look at those numbers, if you have 1.25% and on one side, and for productivity, and 0.6 is the lowest part on the labor force growth side. 0.6 plus 1.25, hold it. Somebody got a calculator? Okay, that's basically a little over 1.75, 1.85%, a little less than 2% growth. On the other side, if you have 1.75 and maybe 0.75, you have roughly 2.5. So if you average them up together, you have growth in the 2 to 2.25% rate. That's sustainable. Sustainable in the sense that you don't create bubbles and create massive problems that the economy ultimately runs into. And that's where you ultimately get to, regardless of what's been going on. Now, how did we get to 3% growth, which is significantly faster than this 2 to 2.25% growth, which is trend? Well, we did something we almost never did before. We actually never did it before. We were growing pretty well, and we had a massive tax cut. And as every economist would have told you, because we like the phrase that we all came up with just about at the same time, we will hype the economy for a while, but just like an ice cream break, when the sugar high wears off, you're going to slump. And what do you slump back to? If the economy was already growing decently, you go back to trend growth. Guess what happened? We've moved back to roughly 2% growth or so. A little bit more, a little bit less. The summer quarter, which ends on September 30th, looks like it's going to grow at 2%. The spring quarter, we got the final estimate, at least until they revise it in a couple of years, was 2%. Guess what? We're growing at roughly 2%. Is that bad? The answer is no. It's not bad. It's trend. It's what we have. The problem that we have is that we don't feel like it's really good compared to where it was when it was 3%. Then it was hot. Now it's normal. It's like being 90 degrees versus 75 degrees. 75 degrees is real nice, but it's nothing special. 90 degrees feels hot. That's kind of the difference that you have at this particular point. So we have an economy in the U.S. that's growing at a trend rate, but it doesn't feel good. The worst part about it, though, is that we've created some real issues. So instead of growing at 3, we've come back to trend. Where do we go from this particular point? And that's the thing that the Fed is most worried about. And it's the thing that's driving them, the members on the Fed. And it's the thing that will determine whether they cut rates again this year or not. Or maybe, if they don't cut rates this year, I'm not going to tell you what I think. Actually, I will, but it's going to take a while for me to get there. I have a little while to do that. Just making sure that the sugar. How long does it take for a kid to, sugar high to wear off? What do I figure? 30 minutes? Okay. But what's the Fed worrying about? The Fed's worried about the economy potentially weakening. Why are they worried about the economy potentially weakening? Because the Fed has what's called a dual mandate. It's got to essentially maximize employment and have inflation stable. Now, what's called stable? The Fed determines it. Right now, the Fed calls stable inflation 2% inflation. You really don't want lower than 2% inflation. This is actually a rational thing. 0 is not a good inflation rate. It may seem that way, but why isn't it? Because the economy ebbs and flows. And if you went into a recession and inflation was at 0, what would happen? Inflation would fall, and it might go negative. That's called deflation. And that's about the worst thing that could ever happen to an economy. Why is it the worst thing that ever happens to an economy? If all of your assets depreciated, who would buy a depreciating asset? Well, I do that. My investment strategy is buy high and sell low, but it hasn't done me well. That's why at my age I'm still speaking in front of different groups. But that's not what most people try and do, okay? So deflation, where prices actually fall, is the worst thing that can happen because people put off buying, and if they put off buying, demand falls. And if demand falls, the economy slows further, which just creates an even worse downward cycle. So now the Fed's worried that the economy's slow, and what the problem they're facing is for the last 7 years, maybe 6 months, 8 months out of the last 7 years, inflation has been at their target rate, which is 2%, give or take a little, roughly 2% plus or minus a little bit. So the Fed is very, very worried about it. Why is the Fed worried about a potential slowdown? The economy had been growing pretty well. Okay, we knew it was going to come back once the sugar high from the tax cuts faded. So if we're growing at 2%, why should the Fed be concerned? We were growing at 2% most of the time frame in the recovery during the Obama years. And they actually raised rates, if you remember, when we were growing at 2%. So why now are they thinking something different? The problem is that when you look at the economy, there are challenges to just about everything. Probably the biggest challenge is the trade war. There's no question about that. As one of my colleagues commented, anything that has war in it is not particularly good, all right? It's not easy to win. Keep in mind, we've been in this trade war almost 18 months now. In March of 2018 was when the president made the comment about tariffs, a trade war being easy to win. Doesn't take long. It's going to be easy to win. That was 18 months ago. Very soon after that, they announced the first set of tariffs and really started the process. We've been going through this for 18 months now. It's not a quick and easy thing. The problem with tariffs is that it creates counteractions on the part of the people who you've put tariffs on. So what have the Chinese done? They've reciprocated in kind. I don't think the farm sector is very, very happy not selling very much. If anything, there are some crops that are just not being bought by China anymore. So what you have is a situation where our exports slow down, And our imports either cost more or the companies that actually do the importing have to pay the tariffs. Keep in mind, a tariff is not paid by the country whose goods are being taxed. It's a tax. Why? Because there's no tax placed on the goods until they actually enter the country. So who's responsible for paying the tariff? The company that does the importing, which is a domestic U.S. company. They have to pay those costs. Now, what's been happening is, to a large extent, they've been absorbed. But if you take a look at, for example, GDP report came out today, and corporate profits were largely flat, which is telling me that an awful lot of those tariffs were taken out of profits from companies that either do the importing or use the goods that are imported, because the prices get passed on. I was with a group of manufacturers, small manufacturers. They're about $20 million in sales or less. Those are small manufacturers who are really producing goods for other manufacturers. They are producing specialized products. And they were using all sorts of metals which had tariffs on them. Their costs were going up, but if you're producing a specialized product for Boeing, for example, for an airplane, Boeing's not going to say, okay, you can raise your prices to me. They're going to tell you to eat it. They've been eating it. Their profits have been going down. They've been trying to pass it on, but there's a difficulty in doing that. So what's happening is that, first of all, the tariffs reduce exports and raise costs, and that slows the economy down. So if you're down to 2% and now the economy is slowing more, you've got a secondary impact, which is really a concern. And that's the fact that as the economy slows, you have all these crazy economists like myself saying, we could have a recession next year. And I actually have a recession in my forecast, a small one, but just to signal that there is a distinct possibility that that could happen. And to some extent, it's almost a self-fulfilling prophecy. Why do I say that? Well, if you're a business person, especially in a large company, and you're seeing the economy slow, which it would have anyway, as I said, because the impacts from the tax cuts were already wearing off, and now you're seeing, a slowdown due to the tariff war that we're involved in. And keep in mind, it's not, what happens in China doesn't stay in China. What happens in the U.S. doesn't stay in U.S. All right? What happens in AC doesn't stay in AC. Okay, it's not Las Vegas, but it's close enough. Okay. The idea here is that the U.S. isn't even China's biggest trading partner. Europe is. The EU, the European Union, is China's trading partner. What's happened to the Chinese exports to the U.S. is that they're down over 10%, and it looks like they could be down as much as 20% this year to the U.S. It'll probably be closer to 10, but if things keep worsening, it could be even more, which means the Chinese economy is slowing. And now that's supposed to put pressure on China, and it clearly is putting on pressure on China potentially to negotiate. But what it's also doing is affecting Europe, because if Europe is China's biggest trading partner, if China slows, the demand for European products slows, and what happens to the European economy? It's slowing. So now let's step back a second. We have the U.S. slowing, we have China slowing, and we have the EU slowing. We have the three largest economies that make up most of the world's economy slowing down, which now means we're in a worldwide economic slowdown. You're a business person. You know this. You see this happening. Are you going to go out and invest in something, even with the tax breaks that have been out there? It's nice, you got great tax breaks, you can write things off almost like crazy, except if the economy is slowing, are you going to wind up with a factory that has no demand for those goods? If that's the case, you're not going to invest. So businesses have pulled back on investment. So first we had trade slow down. The trade war not only affected trade itself, but it affected business outlook for the future. So when businesses start getting worried about the future economy, they slow expenditures on capital. They're building fewer plants. Why build a plant if you're not going to need it? Why upgrade the machinery if the demand for the greater output is just not going to be there? These are the things going on. So when we take a look at investment in the second quarter numbers was negative, despite the tax cuts. And that spills over to the next part of the economy. Who's been driving economic growth? It's been the consumer. The consumer's been buying like crazy. We're at the lowest, basically the lowest unemployment rate we've seen since the end of World War II. Wages have been rising a little bit faster, not at any breakneck pace, but a solid pace. Incomes are growing, so people are spending money. And that's what's been driving the economy itself. And there's been tremendous job growth as a result of that. Well, when the economy slows and businesses get more cautious, not only do they slow down their investment spending, but now they become more cautious on what? On their hiring. So what have we started to see? Job gains begin to slow. So now when job gains slow, wage growth slows, income growth slows, and what are we likely to start seeing? Consumer spending slow. All right. So now you've got, anybody remember their econ, their first macro course? Anybody remember that? There are 4 components of the economy: consumers, businesses, the trade sector, and government. The consumer was carrying things, but they're slowing, trade is slowing, and business is slowing. And then we get the government, which I'm not going to talk for the local governments, but I will talk for the federal government. They're spending money like crazy. And it's been one of the things, and probably one of the key things, that have kept growth rates even up to 2%, because the government's been growing a lot faster. But the problem we have with that is very simple. 2 years ago, we had a budget deficit of roughly $540 billion. Now, that's a lot of money. I'll take a small percentage of that and retire. This year, we'll have somewhere between about $960 billion and $1 trillion. If we don't hit $1 trillion this fiscal year, which ends, the federal government's on a October 1, September 30 fiscal year, we will have a situation where we'll get to it next year, which means the federal government, in terms of spending more to try and boost the economy, is pretty much in the straitjacket as well. So what we have is a situation where the Fed is concerned that there are challenges to all elements of the economy, and the outlook is for slower and slower growth. And so that's why, despite the fact that growth was good, the Fed was cutting rates. Will that help, or will they continue to cut rates? That's a different question. On the issue of will it help, the answer, at least as far as I'm concerned, is no. Why is that the case? Well, when you cut rates, you're trying to reduce the costs of doing things such as building. So on the business side, it's capital spending. And on the household side, it's borrowing money to either buy a house or a vehicle, okay? Will those lower rates actually change things significantly? Well, we already talked about why businesses are slowing capital spending. Does it have anything to do with their cost of funds? No, they have massive tax breaks. They have lots of capital sitting in the banks. They have every reason in terms of the financial side and the corporate finance side to invest. That they're not doing it means it has nothing to do with the fundamentals of finance. It has to do with the fundamentals of the economy. So if you cut rates, are you going to induce business to invest? Probably very little, if any at all. What about housing? Housing, whether it's New Jersey or even the rest of the country, we've seen housing slow. When I say slow, on the price side. Demand has been slowly rising, but it hasn't been rising very, very rapidly. It hasn't been rising despite the fact that we have extraordinarily low mortgage rates. Let me give you a question here. I bought my first house in August of 1981. I don't want to date myself, but I said I'm a baby boomer, okay? Anybody want to take a guess what my mortgage rate was? 14. Go ahead. 12. How much? 20. All right, we get somebody closing in on it. No. My first mortgage rate was 17.5%. Crazy, right? Except when I walked into to close on the mortgage, the banker said to me, anybody, bankers here, this is the way bankers were then, okay? Said, your mortgage rate's 18%. I said, what are you talking about? You told me yesterday it was 17.5. He goes, okay, it's 17.5. I said, this is a true story, okay? So I was really glad to get a 17.5 instead of an 18, right? But the reality is that though, somebody bought a house, not a whole lot of people. Every month the federal government announces the number of homes sold, right? And the National Association of Realtors puts out existing home sales. Well, in August of 1981, there were so few homes sold that instead of saying how many homes were sold, they listed the names of the people who bought them, okay? And in Amherst, Massachusetts, I was a professor at the business school at UMass Amherst at the time. I was a tenured professor. And I left. I figured anybody who would give me a lifetime job suffered from a gross lack of common sense. And then I went to Fidelity Bank in in June. And in July, the CEO, the chairman, called a meeting of all the senior officers. And he said, I have some news. And everybody looks around and goes, uh-oh. And I'm going, what's going on here? And it turned out that we bought the other bank rather than the other bank buying us, which would have meant that after, even though I had a tenured faculty position, I would have had a job for 1 month, okay? And I would have been out of a job. And that showed that I had a gross lack of common sense, but, mortgage rates, people are talking about a 4% mortgage being high. I refinanced after 1 year, and I went from 17.5 to 11. My cut in my mortgage rate was 6.5 percentage points. All right? And you're talking about 4% being high. We've come to be spoiled by very, very low rates, which is a real issue as far as the economy is concerned. Which means that, we're not going to see a whole lot as far as the impact on lower rates on housing, especially since millennials, which should be the driving force in the housing market, are just not buying homes at the pace we would have expected them to buy homes at. Part of it is they just don't have an interest in it. The other part is they're so burdened by student loans, they can't finance it. And this is not going to change right away. Now they're getting older. The leading edge of the millennials are in their mid-30s now. So they're no longer kids. And we think of them as kids because I have a 30-year-old millennial. Thank God he doesn't live at home because we subsidize his rent. But a lower rate is not going to change the decision to buy a house on the part of most of the millennials. So that's not going to change it. So rates don't really matter. So you ask the question, will lowering rates make a difference? The answer is probably not. But they're doing it anyway. So the question is, will they continue to do it? And my answer to that is, it depends. It's like, one thing about economists is you never want to give a certain answer. When I say about my economic forecast, it's today's forecast. It's not yesterday's and probably won't be tomorrow's. But the idea is that, why do I say, will they cut rates more or will they stop raising rates? It depends upon the course of the economy. The Fed's been saying, if you watch them, everything's data dependent. No idea anymore what that means, because if you look at the economy, as I said before, we're growing at the same pace, that when we saw it a couple of years ago, the Fed was raising rates. So now we have that same pace, and they've been lowering rates. So what that all means, I don't know. But the point is, when you really sit back and look at the economy, it's not in bad shape. And there's been a lot of disagreement on the part in the Fed itself and on the part of economists on whether they should be, lowering rates anymore. There seems to be a growing group within the Fed who seriously believe, and two of them, said that after the last meeting, that no, we shouldn't be lowering rates. There's somewhat of an insurrection at the Fed going on right now. So I'm an outlier. I'll admit that. I lie a lot. That makes me an outlier. Now? Out and out, right. And I don't think the Fed's going to necessarily lower rates anymore this year, because I think we'll be getting a group of economic numbers that simply argue this 2% is sustainable for a while. That doesn't mean it will be sustainable, because the big risk that we have out here still remains the issue of the trade war. I'll say this. Recessions don't happen simply because an economy wanders into it. You don't age into a recession. It's either done because there's a bubble that bursts, such as the dot-com bubble in the 1990s, or the housing bubble in the 2000s. When they burst, they took sectors down with them and drove us into a recession. Here we don't have any really great bubbles. The equity markets may be a little high. Bond prices may be too high, which means the rates are little bit too low. The housing market, got a little fluffy in some areas, but that's begun to ease back. That wasn't nationally. I mean, think about what happened to prices, 10 years ago, 15 years ago in New Jersey compared to what's happened in the last 5 years here. It's been nothing like it, right? We don't have the same thing. So there's no real great bubbles. The labor market is a little bit too tight. That's a bubble. But until we see wage, gains accelerate. The other way you get into a recession is if there's a policy mistake. And here we probably had two policy mistakes already. One, the tax cuts. And I've argued this, I've written about this. Not that I think tax cuts are bad, but you don't cut taxes when the economy is in good shape. You need to keep that as a fiscal, stimulant in your pocket just in case the economy goes bad. Now, as we saw, the budget deficit has skyrocketed. And as any economist will tell you, and I say this all the time, tax cuts don't pay for themselves. They never have, they never will. Indeed, the next tax cut that pays for itself will be the first tax cut that pays for itself. So we had a policy mistake on the tax cuts. And now we're having a policy mistake on the trade war. So that's the biggest risk. And if the president goes through with raising the tariffs in October and November and December as is scheduled right now, and we get up to 25% tariffs on the Chinese products, we will likely be in a recession, because that will clearly slow things down in China, in Europe, and the US, that we can't escape it. Okay? Under those circumstances, you will get rate cuts, but that may not come until the spring or the summer. So my feeling is, we could get another rate cut. Chairman Powell has boxed himself into a corner. But I think if we have some decent economic numbers over the next couple of months, they don't have to be strong, they just have to be decent, they may back off of it. At which point they can then start waiting for the economic weakness. Let me wrap this up so I can get to some questions quickly. What does this mean for New Jersey? New Jersey's economy is in decent shape. The unemployment rate is the lowest it's ever been since they started having statewide unemployment numbers. It's as good as it is. The problem with New Jersey is that job growth has been underperforming. And that's been consistent for most of the time since the recovery began in June of 2009. There are some short periods of time where the state's economy, did a little bit better than the nation, but there hasn't been a lot. But New Jersey is, I'm really positive about the state. I'm really upbeat about the state. Because if you look at the future economy, not the current economy, the future economy is a distribution economy. Same-day delivery, the Amazons of the world, ultimately what they're doing is delivering goods. The key is goods. Remember, you can have all the dot-coms you want, all the internet you want, unless you're trading goods or services, you don't have anything that you're making money on. Right? The only reason Facebook or Google makes money is because they're advertising real goods and services. That's how they make their money. So you need to be distributing real goods and services. New Jersey is perfectly situated to do that for lots of reasons. We've got the ports, we've got the airports, we've got the highway structure. We've got the infrastructure, which needs to be rebuilt even more so, to distribute those goods. And we're situated in, within several hundred miles of, significant proportion of the population in the U.S. So where would you like to be? New Jersey's a perfect place. You add to that the fact that something as different as the new Panama Canal, where you can have these huge ships that no longer have to stop on the West Coast but can come up the East Coast, that's changing the flow of goods. And of course, one of the reasons the Jersey economy is not doing that well is because where does a lot of those goods come from? Asia. What's getting killed? China, okay? We want them sending goods here because we will distribute them. That's our economy. But the state is perfectly situated if we can make the investment to keep this distribution economy going. And so while we may have a slowdown now, I think as we look over the next 5 to 10 years, it has tremendous opportunities. We just have to be willing to make the investment to bring those opportunities forward. So my basic outlook on the economy and interest rates is that the economy doesn't have to go into recession unless this trade war continues and heats up. If it doesn't continue and heat up, then we'll probably go back to this 2% or maybe even a little bit slower growth for a period of time. If it does heat up, we go into recession. If it doesn't heat up, then the Fed doesn't have to lower rates anymore. If it does heat up, the Feds will be lowering rates, but maybe not until the spring or even the summer. Okay? That's my forecast. I'm sticking with it at least until tomorrow. Questions? Yes? Okay, what's my opinion of the minimum wage increase for the state of New Jersey is the question. And my answer is that it's like an economist. The problem with the rise in the minimum wage is that it helps a lot of people, but it hurts a lot of people. And the reason it helps a lot of people is obvious. There's going to be an awful lot of people whose incomes are going to rise, and that's going to generate an awful lot of additional demand as incomes grow. The problem with a minimum wage rise is that, where is that money spent? It's not necessarily spent on the businesses that could get hurt the most by it. So if you have a mom and pop store, selling certain kinds of specialized goods, that doesn't mean that their demand's going to grow dramatically, but their wage rates will grow. So what you have is a trade-off. Like economists like to say there's no such thing as a free lunch. There's no such thing as a free increase in the minimum wage. You'll have some people helped, some people hurt, and that becomes a political decision. Economists can tell you what's going to happen, but whether you're willing or not to make that trade-off is basically a political decision. It's a societal decision. And so that's the economics behind it. And I think right now what the state has basically said, they feel that the gains from the low-income households getting higher income more than offset the costs to the businesses that get hurt by it. Okay? Questions? Yes, back there. Okay. The question revolves around an issue that's occurred most recently, which is called the repo market. Don't even worry about it, okay? Well, you guys know what the repo markets are, right? Okay? The problem was that the repo market got out of balance. Supply and demand got out of whack. What happened was that there were a couple of things that happened at the same time. There was a September 16th tax payment that occurred. At the same time, there was settlement on a treasury auction. And what both of those did was take money out of the financial system. So companies pay taxes. That took it out of the financial system, transmitted to the government. Companies and individuals and banks paid for the bonds that were auctioned off to pay for this huge debt, and that took money out of the financial system. The Fed's money model failed. So that what happened is supply and demand came out of whack. The repo rates went skyrocketing. The Fed had to inject lots of money so that the supply went up and the price went down, okay? So they did that, and until these things settle down, when you get into a disequilibrium situation, things kind of go wandering around for a while. You don't have to worry about it. It was really more a mistake on the part of the Fed's money management and modeling than it was on something that's real. Now, it was a signal that the Fed has to keep probably some extra liquidity in the system that they didn't know about. But that's more of a technical issue than something most of you need to worry about, because the Fed can manage the Fed funds rate at any level and any level of liquidity, okay? So it's really not an interest. Ultimately, it's a short-term problem, but not a long-term or even a mid-term kind of problem. Questions?
Will we see a continued growth in the federal deficit?
Will we see a continued growth in the federal deficit? I see no way out of it at this point, okay? I had no problem with tax cuts. What I had problem with the tax bill was it was only tax cuts. It wasn't tax reform. So a lot of people got tax cuts, but it wasn't done in a way that increased the efficiency in the economy. And then when businesses didn't take the tax cuts and invest it into capital spending, you didn't have more efficiency through the investment side. So what you had is a situation where we basically reduced the tax payments, but didn't do anything with it other than the federal government spending some of it, which made the deficits more. And if you're looking at 2% growth at a lower set of tax rates, you can't make it up. Let me give you a simple example. It's simplistic, but I'll give it to you. If you made $1 million and you had a 35% tax rate, you paid $350,000. If the tax rate dropped to 20%, you're only paying $200,000. How much at 20%, do you have to make to equal that 350? 175,000, 1.75 million, which means you need a 75% increase in your earnings. How long is that going to take? A very long time to get there. That's why the mathematics of tax cuts is so daunting.
What I read was most companies with these tax cuts use the money to buy back their stock rather than invest in. Is that true?
Yeah. When we take a look at it, this is something, the point was most companies spent their tax cuts to buy back stock. What they did was they took their tax cuts to buy back stock, increase dividends, and increase compensation. And that's what economists said would happen, because on all the other tax cuts, this is one of the most studied things. Economists actually do something other than pontificate. We did look into previous tax cuts, and we found that anywhere between 60 and 90% of the tax cuts went to those exact things. So the best guess is split it down the middle, it'll be 75% would go that way. And that's pretty much exactly what happened, which is why we didn't think it would create any extended period of growth. You got some extra money people spent. Some of the smaller businesses that wanted to invest now had the capacity to do it, so they did that. But it wasn't massive, and that was the big problem. I got time for one more question. You didn't ask a question, did you? Okay, yeah. Oh, policy mistakes, and do I want to comment on central bank independence? I was really shocked that nobody, I didn't put it, by the way, the one thing that you haven't asked me about, which is shocking, is negative interest rates, okay? And that pops up with the issue of should the Fed remain independent? Let me ask this question. Do you want Congress or any president to run monetary policy, given the way they run fiscal policy? The answer is, God, no, please. All right? So yes, I am, you absolutely have to have the Fed totally and completely independent. And along those lines, while the president is demanding negative interest rates, which I know former Chair Yellen absolutely ruled it out, and current Chair Powell has just last week ruled it out. I don't think the Fed does not want to go there. I know Alan Greenspan thinks we're going there, but let me just spend 1 second, on that. If you go to negative interest rates, nobody knows how to get out of them. Just ask Europe, ask the Japanese. Nobody knows. What does a bank do? Give a mortgage at a negative rate? Give me a break. How many bankers here want to have negative mortgage rates? Now, if you're borrowing money, you want it as negative as possible, right? So you can pay back as little as possible. But that's not likely going to happen. And the reason it's a big problem is, as you all know here, rates and prices move in opposite direction. So if you're in negative rates and you got to get back to normal rates, the prices have to do what? Collapse. The bloodbath in the bond market would be massive. And that's why it's such a dangerous thing to do. Even low rates are dangerous. You go negative, and it almost becomes impossible to get out of it. And then what do? The financial system ultimately seizes up. And, I'll end it with this, to use a phrase that former President George Herbert Walker liked to use, if that happens, you're in deep doo-doo. On that note, have a good year. Thank you.